How to do trading in 2025 for beginners, even intermediate and advanced. Well, I did about a 4-hour video about a year ago where I literally taught you how to trade from 0 to 100. But this is a much more simplified version from that 4-hour long video, and I want you to learn today fast, quick, and easy. Because truthfully, who the fuck wants to watch a 4-hour video? Nobody has time for that. We want to learn today and make money today. That's exactly what this video is about. And the importance of that is I'm going to show you the things that you only need. In the last video, I wasted a lot of time telling you the stuff that you don't need, and I probably overwhelmed you for no reason. In this video, I'm going to say exactly what you need to take a trade alongside with me together right now on this video. We're going to take a trade together, and I can almost guarantee you that by the end of the time you watch this video, that trade is in profit, because this 2025 tutorial is about to be crazy. So welcome to the No Bullshit Trading, and welcome to how to become a beginner trader in 2025 once and for all. So we do have to start at some point, which is, what is Forex? What is this currency exchange market? Why is everybody flexing profits, flying in private jets, and having supercars? Well, the foreign exchange market is literally everywhere all around the world. Every single country participates in the foreign exchange market. If there's a country with a currency, they are already involved in the currency exchange, where money is transferring from one bank to the other, being exchanged from one currency to the other currency. And this is a $6.3 trillion market every single day. This is a whole lot bigger than the stock exchange market by a mile, and a lot bigger than the crypto market. The foreign exchange market is by far the biggest market that moves the most amount of money and has the most opportunity to make money other than any other market out there. That's why there's so many people flexing profits, making money trading Forex. So the way it works is that you're basically exchanging one currency for the other. So it's like, let's say you're exchanging money to buy a house, or you're exchanging a car to buy another car. You're exchanging one thing for the other, but you're actually doing it with real currency. The euro versus the Japanese yen versus the Canadian dollar, the pound versus the dollar, the list goes on forever. But the key is that you are never actually exchanging one currency for the other. You're never turning your USD into euro and then turning the euro into the Japanese yen. That's not how you make money trading Forex. You make money trading Forex betting that one currency is going to get stronger than the other. It's a lot simpler than owning shares or owning different types of currencies all around the world, because truthfully, that would just be a mess and make this process very hard. You're just betting that one currency is going to get stronger or weaker compared to the other currency on a short-term, medium-term, or long-term gain. So as you're betting that one currency is going to get stronger than the other, for example, Euro USD. Let's say you buy Euro USD. Doesn't mean that you're buying the euro and selling the dollar. You're just predicting that the euro will get stronger than the dollar. Or if you are selling Euro USD, doesn't mean you are selling the euro and then buying the dollar. You're simply just betting that the dollar is going to get stronger than the euro. And the way you make money here is the market is going to move in whatever direction, and there's going to be other people involved in the other direction. So if you bet $100 that it's going to go up, somebody around the world, whether it's a broker, an individual trader, a retail trader, an institution, they have that same liquidity in the market. Keep in mind, this is a $6.6 trillion market. I can guarantee you, every single time you go place a trade in the market, there is somebody on the opposite side of that market with that same exact money. So if I buy Euro USD and you sell Euro USD, one of us is gonna make money, because the market has to go up or it has to go down. And whenever the market goes into either or of our favor, whenever we close out, we get the profit from that other trader, institution, retail trader that they have placed into the market. You're not actually taking it out of their account, but it's just inside of this cloud where all of this $6.6 trillion is being moved every single day. And now, don't worry, if this sounds a little too complex, don't worry. Later throughout this video, I'm gonna literally take a trade with you. I'm gonna show you how I put the money into the market, how we take a trade, how we take the money out of the market, and then we take the money from the broker, then we take it to our bank account. It's a very simple process. Everything should take about 5 to 10 minutes. So in order for you to execute these trades and you determine if you want to buy a market or sell a market, you have to be looking at a chart. These are these charts that go up and down and you see everybody posting, and truthfully, this probably looks like it's Chinese to you and you don't understand what the hell is going on here. Well, I'm here to tell you, I don't speak Chinese and I understand these things better than I understand my girlfriend. I have a better relationship than I have with my girlfriend. And so can you. And it's very easy, and I'm gonna show you how to do that. Now that we are here on the markets, what I did in the last video is I wasted a lot of time explaining to you the things that I do not use on this platform. And I broke them down and explained them in detail for truthfully no reason. I'm gonna explain to you exactly what I use inside of this platform. Everything else that I don't explain, I do not use, and is total bullshit. It is not necessary. The best example and analogy that I can give you on this is like your car. You get into your car, and I'm sure your car has a bunch of buttons and a bunch of settings and a bunch of different shit that you truthfully never use. What you care about is when you turn on the car, the steering wheel works, the brake and the accelerator, the AC, and the stereo system. If all that is good, you're gonna get to your destination perfectly. This exact same thing here. There's a lot of extra things here that are not needed. All I care about is what the price is being reflected, that my wicks are on point, and some of the tools that I need to draw up the drawings on the chart for it to make sense. And you don't need to understand absolutely everything on this platform to make money trading, be profitable, or even understand how to use this platform. So let's get right into it. As soon as you create your account on TradingView, you're gonna go in here and you're gonna add a pair. Simplest way to add a pair is you type up any pair, for example, let's say Euro USD. As soon as you click Euro USD, you can go and click on it, and as you're gonna see how the chart will pop up. If you wanna add it to your watch list for whatever reason, this is the currency pair you wanna add, you hover over this flag and then you just simply tap it, and then you put whatever color on which section you want to put on it. That section will pop up in this section here. Here's where you're gonna have all your different types of currency pairs, all different types of symbols, cryptos, stocks. Anything that has a chart will be able to be added here onto your watch list. You can split your watch list by colors. Each color that you add can signify something for you. Truthfully, I have everything blue, keep all my markets in the same spot. I watch them all the time, and it is a lot better than constantly having to go to different folders to look for them. In here, as you can tell, I have a lot of different markets added because I trade a lot of different markets, and I'm always looking for new opportunities to make money in the markets, because when one market is moving choppy, I go in and move on to another one. If you stay just watching one market, the market could be choppy for days, weeks, months, and you're limiting your opportunity to execute a profitable strategy on a market that is giving you a great trade setup, that is having great trending moves, and so on. So once you add all of your currency pairs to your watch list, once again, say I want to add GBP USD. To add GBP USD, you click on the color option here, or you click on the chart, and you're going to notice how GBP USD will pop up right here. For whatever reason you want to take it out, you can just click the little trash button, or we can just click the color option right here, and then it will remove it from your watch list. Aside from that, everything else in here, other than the symbol, I don't know what the hell this means. I don't know what this means or this means. None of this means anything to me. Obviously, I understand it's what the price is at that point. But for me, I'd rather just go to the chart and see how it's being reflected. I don't need to look at the numbers. I like to look at the charts. The numbers don't tell me anything. The charts tell me everything. Aside from that, on the top over here, you have a couple buttons, which I never use any of these buttons here. The alarms is the only section where I actually dive a little bit deeper in, because if I am waiting for a trade to reach a certain point, but I'm gonna be at the gym, I'm going to be out on the road, and I'm not in my computer actively watching the markets, I set an alarm, and the alarm notifies me like if it was a phone call. The market literally calls me and says, hey, letting you know, trade is here. It doesn't actually call you, it's just an alarm that notifies you that the market is at that point. So if you want to place an alarm, it's very simple. You just go here onto the chart. You're gonna get this little plus sign right here. As soon as you click on it, you can click add alert, and then you're gonna see how you're gonna have an active alert, and it'll be here pending on the chart. For whatever reason you wanna go and you wanna remove it, you click here the garbage can. If you wanna delete it, it deletes it for you. This is the history of all of my alarms, and I'm gonna tell you right now, I get a lot more excited when the market calls me than my girlfriend. So place as many alarms as you want. Gives you a lot better feeling, and it doesn't complain, and it makes you money. I think it's great. Aside from that, I don't know what the hell this is, I don't know what this is, and I don't know what this is here. I don't associate myself with any of these other sections other than just where my currency pair list is. On top over here, you're gonna have your basic back button. So let's say that you draw something and for whatever reason you go ahead and then you delete it. You want it back, click this, it comes right back. Pretty straightforward. Replay button, this is if you want to back test. You go to this point in the charts, and if you want to replay it, you can click down here. The market will go ahead and play itself, and it will be able to give you an idea of how you back test. But personally, I am very against backtesting. I don't think backtesting is good for any trader. I actually think backtesting does damage to traders. I think it creates this false expectation of how the market is going to move. And the fact that you can see what you just erased, it's kind of like you're cheating. It's like you're going to take a test, you're gonna look at the answers, and then you're gonna take the test. How the fuck does that make any sense? It's like right now, all right, tell me what happened when the market got here. Well, you just saw it, you just erased it yourself. So to me, it's a form of cheating. And again, for this to happen on this move, this market took exactly about 7 days. You're gonna play 7 days of the market in 15 seconds. That is very unrealistic, and it's really bad for your mental psychology, because what you're doing is you're creating this false expectation that the market is gonna move that fast. The hardest parts of being a trader is sitting on your hands, whether it's before entering a trade or while you are in a trade. And backtesting messes all of that up. So I don't ever recommend to do it. There's another section for the alarms. You can type up the currency pair, put the price, and basically create it. For me, I never use this option. I always go to the chart directly, and I just click this plus sign wherever I want to add the alarm. This button, I've never used it. Indicators is only necessary if you want to add indicators. I personally only have one indicator, and I use the 50 EMA. So my input is 50, source is close, offset 0, method SMA, and length is 50. This is the only EMA that I use, and truthfully, this does not make or break any trades for me. So this 50 EMA does not determine if I should enter a trade or not. It is literally just an added confluence to give you a perspective on how important this is to me. It's like if you're gonna go buy a car and they say that they're going to wash the car for you, put tire shine, and they give you free gas. That does not mean you're gonna buy the car because of that. It just sweetens up the deal a little bit. It's the exact same thing here. The EMA sweetens up the trade that I'm gonna be interested in taking. Following that, in this section here, you can see that we have all these different types of way on how the market could be seen. You can see the market in this different type of format other than candlesticks. You have these boxes, you have areas, you have columns. There's never ending different ways on how you can see the market. I personally will only and ever analyze the markets on candlesticks. It is the most effective, and it is the simplest way on how you can do it. If you do not trade with candlesticks, you are simply not trading correctly. Sometimes, occasionally, I will analyze with the line chart, because the line chart is easier to identify market structure. Market structure, you can tell if the market is bullish or if the market is bearish. You can identify the trend, place an area of interest. You just see the real raw structure of the market. Versus when you are on the candlestick chart, you could get a little distracted because of these big wicks and rejections, and it could cause some confusion. But the importance is the market structure, and you can read that to the bodies of the candlesticks. If you notice, wherever the bodies of the candlesticks are, which I'm gonna get into detail now on how these candlesticks actually work, where these bodies are is exactly where the structure point is. So it's just a simpler way of looking at the markets without having all these candlesticks. Next to that, you have all the time frames. There's many different time frames out there. I personally only use the weekly, daily, 4 hour, 2 hour, 1 hour, 30 minute, 15 minutes. And as you can see, I have a star in them because then they favorite it and leave them up here. If I want to add another time frame, I just put a star, pops it up here. If I don't want it, take off the star and it removes it. This plus sign and currency pair is a different way on how to search up for a pair. Exactly how we did earlier. But for me, I rather just have to just type it. It's the exact same thing and you don't have to click here. Now, this is just where your profile is, and under all of that are the different tools that you can possibly use. Last time I wasted too much time explaining all these unnecessary tools, which truthfully, how the hell do you even use this to identify a trade? Like, what the hell is that? It's impossible. So to avoid wasting time and bombarding you with unnecessary information, these are the only tools that you will be needing. The horizontal line, the horizontal array, the trend line, call out box, rectangle, brush, eclipse, text, path, long position, short position, head and shoulders, and rotated rectangle. Everything else that is inside of here, all these different patterns, all these different Elliott waves, all these different angles and cycles, has absolutely no use, and you will never be profitable by using them. Once again, how the hell does this tell you if the market's gonna go up or down? This looks like a greenhouse. You ever seen a greenhouse where they grow tomatoes or onions? This is what that looks like. That is not gonna make you profitable. And then moving down, you have one of the most important tools, I would say, is the measuring tool. This measuring tool measures how much time something is and how long in pips something is. I mainly use it for the time. So if you see as I go to the right, this little option here is increasing because that is how much time this market moves. For example, this market from this point to where it is now was 20 days and there was 14 bars. If we go from here to here, this market moved from this point, from where this line is to where this line is, 99 days, and it has 69 bars. This is a form of measuring time and pips, pretty much. This plus sign I've never used. Everything under here I've never used except this I right here, because sometimes you could get a little lost if you have a bunch of different drawings on your chart. And sometimes you just want to see what the market looks like without of them. And instead of having to delete them, you just simply remove all the drawings and then you can put them right back. It's an easier way on how to get a clear visual of what the market is doing. This section over here, I don't know what the hell this is, just a bunch of random numbers that are always moving whenever I'm moving the tool. I have no use for it. Down here, you can see that this is the date of where the market is. So if I were to go to this candlestick right here, and look at the bottom, that is Monday, 13th, January 25th. If I go over here, Friday 22nd, November 2024, just a way of measuring the time of where the market is at that very point. And this is just what the value is. Picture it as Bitcoin. This is the price of Bitcoin. Right now it's at 96,000. Up here, the high was 109,000. For the currency pairs, it's the exact same thing. This is what the currency pair is worth right now, 0.627. And the little time under it is how much time each candlestick is left per time frame that you are in. For example, right now we're in the daily time frame. This daily time frame has 1 hour and 54 minutes left before it closes. Go to the 4 hour, has the exact same time. If I go to the 30 minutes, the 30 minute has about 23 minutes left before this candlestick closes. And it's basically never ending per each time frame. This is an overall gist of what TradingView is. Very advanced, very straight to the point, only focusing on the things that you need. There's so much more on this platform that I can spend hours talking about and telling you why you don't need it. But what's the point in that? All you care about is how to analyze the market correctly, how to properly place your trade, and how to read the market. You don't need to know what the tools are. That's not gonna help you how to read the market. So now that you understand how TradingView works, I'm gonna explain to you how a candlestick works. Now, keep in mind, what you are seeing is a direct representation of what the market is doing in candlestick form. What does that mean? Well, let's say right now you're a hunter and you're gonna go hunt in the woods, Everglades, wherever a hunter hunts. I've never hunted in my life, so I have no idea. But let's say you're gonna go hunt in the woods and you are chasing an elk. You're following their foot tracks. These foot tracks is telling you where the elk is going, where this animal is going. Is it going up a mountain? Is it going down a creek? Is it walking in a straight line? Is it doing circles? It tells you exactly what the elk has done. if the elk has laid down, if it took a shit. You can see it in the trail because it's literally telling you where the elk is and where the elk is going. This is the exact same thing. Euro USD is the elk, and this is the trail of Euro USD. What we are doing is following the trail of Euro USD, but in candlestick format. You follow the tracks of an elk because the hooves are left on the ground. Those are your candlesticks when you're hunting. And you can tell by looking at the hoof if it's a male elk, if it's a big elk, even is an elk, it might be a bear, it might be in a really bad situation, but you can identify what animal you are following. When it comes to the markets, you could identify if this market is moving fast, if this market is moving slow, if this market is moving in the trend that you want, is it even trending? You can identify everything by candlestick. So whenever the market is moving upwards, the candlesticks are blue. Whenever the candlesticks are moving downwards, the candlesticks are red. And I mean when it's moving upwards that it's blue, and downwards when it's red, because just because a candlestick is blue or red does not mean that that is the trend of the market. It does not mean that that's where the market will be headed for the rest of the hour, the rest of the day, the rest of the week, the rest of the month. That is just that current specific move. Perfect example. Let's say an elk is going up a mountain. The elk is not going to go up a mountain straight up, because on the way up to the mountain, there's probably trees, there's probably big boulders. You have to go up and around objects to then get to the top of the mountain. But there's times where the elk had to go down to go up. This is the exact same thing here. Just because there's some type of movements that move downwards and back up and downwards and back up, doesn't mean that every single time it goes up or go down, that it's gonna go in that direction permanently. There's an overall movement, and these minor retracements is just part of the market doing its journey to get to the overall point. So the candlesticks leave a trail, and when a candlestick opens, it has 1 hour, 30 minutes, 4 hour, whatever time frame you are on, to create that trail. So let's go to the 15-minute that we are in right now, for example. And this candlestick right now, currently, as we are speaking, it is creating a push to the upside. Now, if that candlestick has a retracement and it starts moving back to the downside, it will leave a wick like how this one is right here. That is the trail of that candlestick at that very moment. As of right now, there's about 3 minutes left before this candlestick closes. And as soon as that candlestick opened, it created a little move to the downside. So that candlestick was red, probably for a couple seconds, and then it kept pushing up. So you guys can see right there, the wick that candlestick has already left is because the market was all the way at that high point at one point, which is a couple seconds ago, but it started retracing a little bit. So this wick is not confirmed until this candlestick does not close. Once this candlestick closes, then that move is 100% certain. But meanwhile, the time is running and the candlestick is pushing, the candlestick is not confirmed having a wick or no wick. This wick right here is the trail that the candlestick leaves behind. When there's a really, really, really big wick, that means that price did not like that area. The best example that I could explain is if the elk was coming back down, it saw, let's say, a potential shooter, and it completely ran up the mountain. It did not like that area. That is kind of the direct representation of what a wick is when it comes to the market. The market gets to a certain point, doesn't like it, and then it rejects it. And each different candlestick creates their own wicks, creates their own movements, and have their own meaning. Obviously, the higher the time frame, the stronger and the more respectable that candlestick is. A candlestick that takes 15 minutes to form is not going to be anywhere near as respected as a candlestick that takes 1 week to form, or a day to form, or 4 hours to form. The higher the time frame, the more respected the candlestick is always. Keep that in mind. So as you guys can see, there's about 15 seconds before this candlestick closes, and I've seen some crazy shit in the past. With like 3 seconds to close, this candlestick will literally fly up or fly down. So you can never trust these candlesticks until it does not fully close. It is not a confirmation until the candlestick doesn't close. Believe me, you do not want to make that mistake. So right there, we can see how a couple of minutes ago, it was all the way up here. It looked very bullish. And then now that it closed, it has closed with a rejection, meaning that this can now head to the downside. Now, once again, you can't believe this candlestick that it's gonna now completely go to the downside because there's still a whole 15 minutes. This can take 13 minutes being stuck here, and the last 3 minutes it has the move to the upside. You will never know exactly what is going to happen and when these candlesticks are being formed. But bodies are the strength of it, and the wicks are the trail of it. Remember that. Now, in order for you to execute these trades, you need to have your money somewhere so you can execute these trades. Back in the 80s, if you were to want to enter a trade, you would have to call a broker and be like, hey, I want to enter a trade. You will send the money, you will send the wire confirmation, and then they'll take the trade for you. Nowadays, we're in the 21st century. This is a lot faster now, and you can do it within seconds. But using a broker is like using a bank account. There's many great bank accounts, and then there's also shitty bank accounts. There's great features on some and bad features on others. But there is trusted bank accounts. And in order for you to pay somebody, in order for you to pay for a car, in order for you to make your light bill payment, in order for you to pay for your credit card, you need to have a bank account. Now, a bank account is the same exact thing as a broker. Why? Because this is where you're going to store your money, put it into the broker, and when you're in the broker and you go execute a trade, the broker will then deploy that trade into the markets. The broker is the middleman in between you and the markets. They make sure your trade gets executed on time and exactly where you want, and they make sure that your money is safe. Same thing as the bank account. The bank account is the middle person in between you and the person you want to pay. They make sure that your money is safe and that you pay your person on time and everything gets well. Now, there is hundreds, thousands of different brokers out there. I don't believe there is a best broker. I believe that there is a trusted broker. This is the current broker that I use right now, which is LQH Markets. Been using it for a very long time. My whole entire community uses it. And it is an option that if I were to recommend people to, it would be this one. If there were to be a different option that I would recommend, I would, but this is the trusted one that I recommend. There's many out there that I'm sure that are better, have better commissions, they have better lots per sizing, but this is the one that I personally use. I love it. It is offshore, crypto in and out, quick and easy deposits, leverage 1 to 500, and I've personally put in a lot of money and I've taken out a lot of money. The only con that I would say is that this broker right now, if you are in the US and you're trying to access it, it simply will not let you. You gotta turn on a VPN and then it will let you access this broker. But if you, for whatever reason, cannot access this broker with a VPN and you want another US version broker of this, I'll leave the link in the description for that broker as well. So after you create an account with LQH, this is kind of what the inside will look like. This is an account that I created probably like 2 months ago with some students on how to actually create an account, deposit money, do the whole nine with it. And this is basically your portal. So if you were to have a bank account with Chase, Bank of America, or whatever bank in your country, this is the inside of your bank account. This is where you're gonna be able to see how much money you have, the different types of accounts, how much money you have available, and all of your transaction histories. Now, this is just the bank account. The bank account is where your money is stored. Now, there is a platform where you're gonna be able to send the money and execute trades onto the real markets. Now, the simplest way that I can put this analogy, and I'm gonna use a US version because I have a US bank, and I think the majority of the audience is in the US. Let's say we were to have a bank with Chase Bank and you wanna send money to somebody else's Chase Bank. You can use a couple different platforms. You can use Zelle, you can use Cash App, you can use Venmo, you can use PayPal, you can use wire transactions. All of these different platforms is where the bank puts the money into and uses this platform to execute that transaction and send it to someone else. This is the exact same thing. This broker is a platform where then it's going to be connected to MetaTrader, where on a MetaTrader, you're gonna then be able to execute your trade, whether you want to buy a trade, sell a trade, so on. MetaTrader is not the platform where you're gonna be able to withdraw the money from. PayPal, Cash App, Zelle, they never have your money. They're just the middleman of the people that get your money and put it into the market. Once the money is made, it goes back from that platform into the bank account. So now that you understand all of this, it's time to actually execute a trade. Right now we're gonna execute a trade together exactly how I would. So I'm gonna take you through the full top-down analysis, the confluences that I'll use, and then the entry signal. I'm gonna take you guys through executing a trade and even closing a trade. I'm gonna show you how in the matter of 10 minutes, I can probably make $100 like that. So let's get started. The first thing I do when it comes to analyzing a market is gonna be identifying the trend. For example, let's say we have this market right here. This market is a perfect example of a market that many traders would make a very big mistake on. Many traders would approach this market and think that this market is currently bearish, or they would think that it's bullish. The correct answer is that this market is currently bullish. If we were to look at the market structure on this market, this is how it would look. Higher high, higher low, and higher high. This is the structure of this market. Higher high, higher low, higher high, and now we are creating structure. I know many of you might get confused and consider this a higher low. I personally do not consider anything that has one candlestick as a point of structure. You need at least 2 candlesticks for the market to then create that proper market structure, so you can consider it an elbow and then where the snake would turn. If there is some confusion for whatever reason, you grab the head of the snake right here, and on your way back, you ask yourself, is this where the snake turned, or is that a little log on a road and then it just continues to go through it? That's a little log in the road. The snake never really changed direction at any given point. So for example, this market would be a great market I would be interested in, simply because we're starting off with the weekly bullish. Next, I would go down to the daily time frame. And many traders would make the exact same mistake at this point here. You would probably think that this market is either bullish or bearish. So I actually want to test you real quick. Go ahead and pause the video and let me know if you think this market is bullish or bearish, and then I'm going to correct you on it. So this market is actually bullish. This market went from creating higher high, higher low, higher high, higher low, higher high, lower low, lower high, lower low, lower high, lower low, and now this is a higher high and this is a potential higher low. This is how this market structure looks. So if we were to look at this on the line chart, because we obviously use the candlestick chart once again to look at the actual way the market represents it, but then if we were to look at it on the line chart, you can see that all of these lines are on the body of the structure points. So you see, for example, that body right there, if we take off the no gap candlesticks, you notice it's where the line chart has created a point of structure. Point of structure is exactly the same as the bodies. You notice right here, these bodies, you take out the candlesticks, point of structure, on the retest of the bodies, and then you notice it's the point of structure. The wicks are just the history, it's the trail of where the market was, but it's not where the market actually stood and closed at. Simplest example is, it's kind of like the trail of when the elk or the bear is walking through snow, and it kind of leaves like that drag, but it's not where it actually left the footprint. This wick is the exact same thing as that. So when I'm looking for the structure, I'm looking for the bodies of the candlesticks. I never actually go to the line chart, because if I go to the line chart, I get too many unnecessary market structure points that it really doesn't count. I would never count this right here as a structure point, but if you look at it on the line chart, it does. So you can use a line chart to kind of practice identifying the higher high and higher low, but I would never use it to determine if the market is bullish or bearish, simply because it's not going to give you the most accurate way that the market is actually moving. You want to do it based off of the candlestick that this market is showing you. So this right here, if you notice, it has 2 candlesticks as of a pullback. You have 1 candlestick and then the other red candlestick. This is a very clean elbow to me. I would count this as a lower low, because this right here would be the lower high, and then this right here would be the lower low. If I were to look at this market like this, and this market, instead of continuing to the upside, and it would have created a big bearish move to the downside, for example like this, that right there would be a very significant lower high point in the market. This would have been a lower low, this would have been a lower high, and then this would have been a lower low. Obviously, that's not the case scenario. The market headed to the upside, but but the principle still applies. And this is something that a lot of traders would make a mistake when analyzing the markets. They'll either overlook it or underlook it. So this market is bullish as well. So we have the weekly bullish and now the daily time frame bullish. Remember that we need a minimum of 2 time frames in sync in order to execute a trade. So now that we understand that the weekly and the daily is bullish, now then we go to the 4-hour. On the 4-hour time frame, let's take this test once again. It's okay to make mistakes. It is part of the game. This is how you learn. Is this market bullish or bearish? Pause the video, take your time, and select. So you probably made another mistake, and it's totally fine because I'm here to teach you, I'm here to help you. This market is actually bearish. So I want you to know exactly why this market is bearish, not because you just made an assumption. This is a higher high. We then shifted. Obviously, the structure in here: lower high, lower low, lower high, lower low, lower high, lower low, lower high, and there's multiple structure in here. Long story short, lower high and lower low. This is how this market structure is currently looking at. It went from creating higher highs and higher lows being bullish to then shifting to being bearish. So this market is currently bearish. This right here at this point is the lower high, and then this point over here is then the lower low. So we have weekly bullish, daily bullish, and 4-hour bearish. We just need 2 consecutive time frames in sync to execute a trade, meaning weekly or daily, or daily and 4-hour. In this case, we have the weekly and the daily, which is good. Now we then move on to the next point, which is area of interest. Because you can have the trend in your direction, but if you are not near an area of interest, the trade simply does not make sense. For example, let's say we're looking at Bitcoin right now, for example, right? And Bitcoin, let's pretend as soon as it created this high move right here, as soon as it broke all-time highs and created all-time highs at 104,340. Yes, the weekly could be bullish because this would be the higher high, this would be the higher low. Daily time frame would be bullish as well. This over here would then be the higher high, then this would be the higher low, and then the 4-hour time frame would be bullish as well. This over here would be the higher high, and this would be the higher low. Oh wow, you have 3 consecutive time frames in sync. That means that you should take the trade immediately. No, this is actually probably one of the worst trades that you can possibly take, because if everything is at a high point, where is your take profit going to be? Where is there going to be a move for price to reach a recent point of structure for then you to place your take profit? There's none, because price is at a very high point, or vice versa if price is at a very low point. If everything is bullish and everything is at the higher high at the highest point, that is not a market you want to be trading. There is no high probability trade setup in that market right there. That is actually a market you want to stay away from. You want to execute markets that are bullish and have the trend in your favor, but have an area of interest. For example, if you are a investor and you want to put money into Bitcoin, you're not going to put money at the highest point. You're going to wait for what I like to call a discount. You're going to wait for price to have some type of a retracement. And as soon as it has that retracement / discount is where then you will enter. And this retracement and discount is also known as price retracing to the area of interest. Once price comes back to this area of interest, then you can execute your trade. And then here, once you go execute your trade, is where then it's going to actually make sense in order for you to place your long position. If you do not have a discount, there is going to be no place on where you can properly place your stop loss and where you can properly place your take profit. And we can just simply play this forward as a quick, very simple example. Here, price had the retracement, had the discount back to the area of interest. All of these 3 things are the same thing, just said in a different way. And as soon as it had a retracement back into the area of interest, you can see how price then decides to go back right up to the high. Now, this is a very simple example of you simply waiting for price to come back to the area of interest. If price is not at the area of interest, you cannot execute a trade. If you can write down a note that is very important, big in bold letters, it would be this one. If price is not at the area of interest, you do not take the trade. You want to wait for a discount. If there's no discount, there is no trade. So back to the market that we were analyzing, we can very clearly identify that we can see on the weekly time frame that we are indeed at an area of interest. If you notice, this area of interest has 1, 2, 3, 4 rejections from this area. A valid area of interest consists of 3 taps or more. It can be 3 levels of resistance, 3 levels of support, 1 resistance to support, 1 support to resistance, 1 and 1 and 1, doesn't matter. As long as there's a minimum of 3 taps at this area, this is a valid area of interest. If you notice right here, this would be then 1 tap, this would be 2 taps, then this would be 3, and then this would be 4. If we were to obviously flip this chart around, it'd be the exact same thing. We would have 3 levels of support, 1 level of resistance, we have 4 taps. This is a valid area of interest, which leads me to understand that now we are then ready to look for the next thing, because we are bullish on 2 time frames and we are at an area of interest. All we need in order for us to enter this trade is simply an entry signal. And after our entry signal, which I'm gonna explain now, we then have to properly place our stop loss, then we go calculate our risk, then we execute a trade. Just because you have a trend, area of interest, and entry signal doesn't mean you go execute the trade. No, you have to properly place your stop loss at the correct point, then you risk on how much you want to risk, then you execute the trade. This is where a lot of traders make mistakes and they end up blowing the account and losing a lot of money. So what is an entry signal that I would look for? Well, one of my favorite formations is engulfing candlesticks. And engulfing candlesticks leads me to understand that that current price is eating the previous price, meaning that it is stronger than whatever's to the left. If something is engulfing something, it's bigger and stronger than what's next to it. So if you have a bullish engulfing candlestick while the trend is bullish at an area of interest, this is the perfect entry signal that you can possibly ask for to execute a trade. And that's exactly what we have right here. Right here, we have a bullish engulfing candlestick right at this area of interest. We have a doji rejection candlestick, which is also one of my favorite rejection candlesticks, which I pretty much use all of the time, only once they are at the area of interest. If it's not an area of interest, it really doesn't mean anything to me. And then after that, we have some type of continuation. For me personally, I probably would not take this trade where price is currently right now, which is at this high. I probably would have entered at this point right here. But for this trade example, we can still enter the trade here, and I can almost guarantee you that we will still make money. So since now we just analyzed a trade with our trend, our area of interest, and our entry signal, let's go take a trade. So let's head back to LQH Markets, where we are going to create a quick account just to show you guys how quick it is for us to be able to actually execute a position. So now we're back at LQH, where we are going to create a new account. So we just take a trade together. When you go create your new account, you can get a commission free, standard, pro, institutional. Just for example purposes, we're gonna use standard account. We're gonna create with a 1 to 500 leverage, and it's gonna be a $10,000 account. So as you create accounts, you're gonna see a pop-up where the demo account was successfully created for you. So now is where you actually go execute the trade on MetaTrader. And if you would see that, I literally just got my email right now where it shows that my credentials to log in to my MetaTrader 5 are already set. All you have to do is create an account with the broker, and then the broker will create an account for you on MetaTrader, which is where you're actually going to execute the position. Remember, LQH is like the bank, and then PayPal is like MetaTrader. So I'm gonna start screen recording here on my phone, and we're gonna simply log into this account. I literally just got the email. I'm gonna go right straight to my email, and I'm gonna log in. So I'm gonna copy my account ID. We're gonna go to MetaTrader 5. We're going to log in to a new server. I'm gonna place the account login. I'm gonna go back, copy the master password, and as soon as I copy the master password, it should log me in immediately. And you can see that our account has been officially created with $10,000. So now we go back to TradingView, and we're ready to take the trade. So let's go execute the trade on GBP CAD. We search it up, GBP AUD. So here on GBP AUD, we would simply come here, click trade, and then we're ready to buy it. Ready? 3, 2, 1. And you were about to make the biggest mistake that 90% of traders make. they have not placed their stop loss, and they have not properly calculated the risk that they want on their account. This is a huge mistake that traders make, and it will completely determine your results in trading, if you're going to be successful or not. You need a proper stop loss, and you need to have risk management. If you are not ready to do this, you are not ready to be a profitable trader. And I want to express the importance of this, because if you don't do this, you will not be profitable. So let's not make that mistake, and let's go to MyFX book, position size calculator, where we're going to type in the pair that we're trading, which is going to be, let's say, GBP AUD. We type it in, we put the account size, which for this example, it's $10,000. And let's say we want to risk $1,000 on this trade. Our stop loss is exactly, we make our stop loss a little bit tighter. Our stop loss would then be 32 pips. So let's calculate here. A 32 pip stop loss. Once you click calculate, it tells you your exact lot size you should be taking. So this would be a 5 lots on the account. Now that we properly have our stop loss number and we have our proper risk management, then we go to GBP CAD, we click trade. Up here, we will then put 5 lots, and then we will put our stop loss number, which is 1.97358. 1.975, and then we will click buy. But before we click buy, I want to let you guys know why we never put a take profit. We don't ever put a take profit because it completely goes again my slogan called set and forget. We set and forget to trade when we are in it. It either hits our stop loss or our take profit. We never place a take profit because we always want to maximize and let a winning trade continue to be a winning trade. Especially when you're trading with the higher time frames and you're trading with the weekly, you're trading with the daily, and you're trading with the trend. This move should continue to happen for 2, 3, 4, 5, 6, 7, 8, 9, 10 days at a time. And by you putting a take profit, you're putting a cap on how much money you can make. You always want to put a cap on how much money you can lose, but never on how much money you can make. Because remember, losing is inevitable in trading, and the only way you make back those losses is by winning. And if you can maximize your wins by analyzing a profitable trade setup, all you have to do is just simply let the market do its thing, continue going with the trend, and it's making you continuous passive income without you doing absolutely anything else. You're not adding any more risk, and you're not analyzing any more trades. So we never place a take profit, we always place a stop loss. So before this market takes off, which it already is, we're just gonna click buy at this moment, and then we execute the trade. So as of right now, we are negative about $141 because we are taking a trade at the worst time possible. It is 4:38 p.m. EST, meaning that the spreads right now are very high. So you can see right here in the quote section, how next to GBP AUD and the time down below, which is 38.57, says 46. There's a 46 spread on this market right now, meaning that it is very, very expensive to execute a trade. So the broker is going to charge you a lot more than it would charge you if it were to be a couple of hours ago. Why? Because banks are closing around the world, and half of the world is basically already offline. So the odds of you entering a trade at this time are not probable. Think about it as if you were to go eat food at a Chipotle when it's like 30 minutes before close. You're getting the worst rice, the worst chicken, the worst beans. You don't want to get the last food that's in the bottom of the barrel. It tastes terrible. This is similar, but with money. Because simply everything is closed and there's no liquidity right now. Things start to pick back up probably in the next 30 minutes to 45 minutes after the markets close, because then a new session kicks in. So from here to then is literally the worst time to execute a trade. And I strategically did this to show you guys on what it is to execute a trade at this time. If I were to execute a trade literally an hour ago, I would probably already be into profit. But since this is for a educational purpose video, this is a demo account, no big deal. But I want you guys to understand, never ever execute a trade at around this time. All right, so now the trade is a negative $37. The fact that I am even about to be in profit in just under 10 minutes at this time in the market is literally ridiculous. This is like if Chipotle would have brought out 5 minutes before closing fresh rice, fresh chicken, fresh beans, This is unseen in the market. Well, now you can see how the market went back down a little bit. This is probably gonna take about another 15, 20 minutes. So market update, probably 7 minutes later. We are literally in the worst possible time to be even looking at the MetaTrader. You know what, I'm gonna show you one of my other accounts. Editors, please edit my information. Where currently I am floating $100,000 in profit right now. This is a challenge account. You saw how I was just $100,000 in profit and it went down to 80 because at 5 o'clock sharp, the spreads go absolutely insane. So you can see here how the spreads are pretty much around the same, but the slippage is ridiculous right now. If I were to close this trade right now, it doesn't matter if you're in the best broker in the world, if you have whatever type of account, you will get immense amount of slippage. If you notice, we're right around the exact point on where we entered the market, and we're more negative than we even started. Why? Because of the spread and slippage the market has. But since this is a demo account for this example purposes, I will be closing at this point right here, just to show you guys how to close your position. You tap the phone and then you just click close position right here. So as you click that close position, you're gonna see it in your history section. You're gonna be able to see how much time you were in the trade and your end results after commission, after the fees. Everything is pretty standard right there, right in front of you. And for those of you guys that don't know what spread and what slippage and what commissions are, think about it, the fees that the bank has to charge you. Whenever you go pay transaction on PayPal, PayPal charges you $4 or $5, a couple of bucks. That's how PayPal makes money, by charging you a fee. When you go to the bank has monthly recurring fees by making sure your account is active. That can also be seen as the spread or the commission. Same thing as when you use a credit card and then you have interest, this could be the same thing as swap. So whenever you hold a trade for longer than 24 hours, you get charged swap. You also get charged commission. Everything is just in fees on when you enter the trade, when you exit the trade, and how long you hold it for. Truthfully, if you want me to be honest, the fees are one, unavoidable. They have no direct relation if it's going to let you be profitable or not. And they are completely irrelevant to how much money you are risking. I like to look at it like the 2% fee. It's just the cost of me making money, or obviously losing money. So if I'm looking to risk $100 on a trade, I'd be risking $102. If I'm making money, instead of me making $100, I'm making $98. So I can hold it a little bit longer so I can make up for the fees, but realistically, 2% is not gonna make or break anything in your trade. It's part of the game, it's inevitable. And trust me, I pay very, very high fees when I trade. And trust me, I pay multiple 5 figures, if not within the month 6 figures in just fees, because it is directly correlated on how much money you risk and how much money you make. I don't know about you, but if I make $500,000 on one trade, I don't mind paying $15,000 in fees. A lot of brokers and a lot of markets out there, they're facilitating this for you to make this money. If you're gonna drop them a quarter or a dime, they can have that. Just give me the big stack of cash. And what I love about this video is that I have been extremely transparent and giving you guys the realistic journey of a trader. What it is that you have to do when you get to the market, how you should approach the market, how you should properly execute a trade, manage a trade. This is something that it's almost like a day in the life of a trader. This is exactly how you should be trading. And there should not be any add-on indicators. There should not be any add-on platforms, any add-on risk tools. This is all you really need to execute the market, analyze it correctly, and make money. I've been as transparent and as direct as I possibly could have been. So picture this as if you were to have just bought a car. The sales guy is gonna tell you the car has X amount of miles, the car has X amount of color, interior, and the condition of the car. But realistically, after you drive off of the parking lot with that car, if there's a check engine light or the car needs an oil change, the salesman has no idea what the hell, how he's gonna do that. That's what I'm doing. I'm getting down deep and dirty. I'm telling you exactly how to do your own oil change, how to properly rotate your tires, how to properly check your engine, make sure that everything's good, your transmission, your AC, your power steering. I'm giving you the ins and outs of your whole entire vehicle, which is your trading plan, which is the market, that is going to get you to success. I'm not just selling you a dream and letting you go and deal with the problems later. No, I'm letting you know exactly what's going on and you're fully aware of it at every single second that you're doing it. And if at this point in the video you still want to see more, you should go check out the 4-hour video. This 4-hour video is everything that I taught you today, but a bit more slow, a bit more in detail. I went into a lot more explanation on fine tuning things that truthfully you might need as a beginner. And exactly how this video was free, so was that video. There is so much value in that video that has literally taken traders from 0 to 50%. That time gap of 0 to 50% took me 2 years. It can literally take you a 4-hour video. So once again, this is all absolutely for free. I ask for nothing in return. All I ask for is for you to hit that like and subscribe button. If you're enjoying these videos, make sure to leave a comment as well. And I personally highly recommend you go watch that 4-hour video, because if you really want to get the deep down details, make sure you go click up here, watch the video, and trust me, you won't regret it. Thank you guys for being part of this video. I'll see you in the next one.